have the gift of the gab, so I've got a little bit of a challenge for them today. I want you to try and answer all these questions in 45 seconds or less. We're going to get straight into it, and the first question is for you, Chris. US politics is arguably the biggest topic in markets or the world right now, with Trump surviving an assassination attempt, Biden dropping out of the race, and now Kamala Harris looking like the likely Democratic frontrunner. How are you thinking about all the things that have happened in the last few weeks?
I think it's impossible to predict precisely how a capricious and mercurial President Trump will behave ultimately, but it is interesting. We're forecasting the Fed will cut rates in September, and the Fed had been railroading to a cut for some time. They're desperate to cut rates to basically lend some support to Biden's campaign. The Fed's been petrified about a Trump presidency because Trump has said he would remove Jay Powell and he'd take powers away from the Fed. And now they've got stuck in this position where it looks like Trump will prevail at the November election. He's going to be unambiguously more inflationary by slashing migration, cutting taxes, and generally sort of boosting consumer prices. And I think if the Fed was a little more prudent, it would exercise the option to wait until November, because potentially we're going to get a radical regime shift in the economic policy apparatus at that point in time. But I think they're going to continue with that current approach of railroading to a cut. I would say that it's interesting that here in Australia we have a completely different juxtaposition where it looks like the RBA could raise rates in August. We're expecting a hot inflation print next month. We can talk about that later. But yeah, very, very difficult to trade. Whether it's risk positive, risk negative, nobody really knows.
Kind of sounds there like you think Trump is going to win at the end of the year. And I know you like to make a controversial prediction or two. So I'm hoping you could predict what you think the outcome of the election will be and how that will impact investors' portfolios.
We don't trade geopolitics sort of day to day, and we actually don't even trade interest rates day to day. But I think Trump will win, and I think the key portfolio sort of impact will be higher discount rates. I think you're going to see larger term premium. I think you're going to see higher long-term interest rates versus the counterfactual. I think you could see the Fed cut in September and then kind of basically draw a line in the sand, a little bit like what the ECB has done. The ECB cut in June and then upgraded its inflation forecast at the same time and said, hey, I'm not sure exactly what we're doing here. We're seeing inflation, signs that inflation may be re-accelerating in various parts of the world. Governor Bullock overnight, really interesting, was very hawkish, saying that we've got a problem with building costs here in Australia, a point made by Andrew. But that would be my central case. Trump prevails. We get more volatility and higher interest rates at the long end of the curve, which is going to be bad for all asset prices.
Okay, over to you now, Jacob. Are you also thinking about the election, or is there other geopolitical risks that you think of investors should be aware of?
Definitely. I mean, in terms of like moulding the portfolio, I mean, Trump is likely to win. Look, it's a question of is it a clean sweep. If it was by the Republicans, it definitely widens the range of outcomes. Though, I think Trump, the two things that are pretty straightforward with Trump is the tax cuts, the corporate tax cuts get preserved. And that's good for, middle American companies. So not the mega cap tech stocks, but everything else. So you might see, as we've seen in the last couple of weeks, some mean reversion where the Russell, which is the mid-cap index, has done quite well versus the NASDAQ. I suspect that pattern would continue. Number two, you're going to get a much more liberal regulatory environment and M&A, right? Like you'll have a lot more M&A take place. There's a lot of pressure in middle America because of those high leverage ratios that we showed. And the fact that the mega caps are taking so much of the available profit pool, that's putting pressure on all these middle American companies. Look, other geopolitical risks, you've got the perennial one of China and the US and the fact that there's just this ongoing decoupling. Both countries are trying to play to their strengths. And China, that means more engagement with the rest of the world, especially the emerging world, which is growing faster than the developed world. And also onshoring the bits of its supply chain that are dependent on the West, like semiconductor production equipment, sponsoring homegrown champions who can deliver all those clever pieces of equipment that they need to stay competitive. Clearly the US is doing the opposite. trying to bring back sensitive parts of its supply chain from Taiwan, which is a very inconvenient thing for the world to have so much of our supply chains so close to China.
Okay, I feel like the world often looks down on the US in terms of politics. It could be argued that Australia isn't much better though. Andrew, we recently discussed this topic in a little bit more detail on Livewire's Rules of Investing podcast. What is the Aussie government getting wrong today, particularly when it comes to housing?
Sticking sort of in we won't talk about the NDIS or things of that nature. Let's talk about real estate. Then clearly there is a mismatch between planning, infrastructure, between state, local and federal governments. And clearly this is not something that is unique to Australia, and we shouldn't forget. Housing issues are prevalent in many of the major cities around the world. And look, I keep saying to people, we can make Sydney, Melbourne, Brisbane affordable if you destroy the cities. Nobody wants to live there, prices will come down. Affordability is the way that cities, regulate the population growth. If Sydney was cheap and it was great, you can imagine so many more people would be trying to live here. So what is happening is that clearly we have an affordability challenge, but what we have is I think it's a mix of real estate or offerings. Clearly social, affordable housing is a massive challenge. To me, that's the bigger challenge. I don't care that necessarily Sydney's unaffordable, because as I say, it's a great city. What I care about is having a functioning place with, I think, a healthy society. And we need to have a broader range of opportunities for a broader range of society through a broader mix of housing. And that's where the governments have to come together and coordinate and provide, I think, solutions. But again, these are great cities. Of course they're going to be unaffordable. That's the nature of when you create something wonderful.
Okay, another major topic right now in markets is obviously inflation.
Oh, and I should say, sorry, has to come hand in hand with amenities and infrastructure. We're seeing obviously some new subways coming into Sydney. Look, Sydney continues to try and increase the infrastructure, and that, by the way, is having a crowding out effect on construction activity at the moment. Again, these are big projects. They're soaking up a lot of labour, a shortage of labour, and then there's the union issues. That's a whole other topic, but it's a massive challenge.
100%. Okay, moving on to another major topic in markets right now, which is obviously inflation and interest rates. I'm going to turn to you now, Anthony. How does Firetrail think about macro, and how does that play into your investment process, and what's your outlook on rates and inflation?
Yeah, so as an equity investor, you want the good work that the analysts do from a fundamental perspective to shine. So across the portfolios, we want to try and control as much as we can for systematic risk and allow idiosyncratic risk to be the driver of alpha and driver of returns within the portfolio. So where I work with our analysts is on those big macro drivers, but as they pertain to impacting earnings for the companies that we're researching. It's so difficult to try and forecast and make money out of some of these big events that I highlighted earlier. Central banks find it hard enough to do with all the PhDs that they employ. And so I don't think anyone has a real skill set in constantly timing the market or calling the market. So essentially what we're trying to do is really control for those drivers.
Okay, over to you now, Chris. You painted a bit of a gloomy picture before in your presentation. You talked a lot about a zombie apocalypse, which is quite emotive language. But we have seen equities trade at or near all-time highs, and we're seeing really good yields from fixed income markets. Is this not a Goldilocks era for investors?
A fairy tale.
I think it depends on what your asset allocation looks like. I think if you're in high-grade floating rate notes right now that can pay 6% interest rate, so you'll get on CBA bonds 6% that back in 2021 were probably paying you about 2%. That's an incredible outcome. If you go and borrow off the RBA like we do at 20 basis points over the RBA cash rate, so we borrow at 4.55 and gear that same bond up, we can turn that interest rate into an 8 to 9% yield. That seems very attractive. Credit spreads, I think, in fixed income are very, very mixed. So if you look at high yield spreads, in the US, which is a proxy for private debt. Single B-rated high yield spreads are sitting at about 280 over US Treasuries. Normally they pay you 550 over US Treasuries. High yield looks heinously expensive, but nothing's trading. No one's buying high yield. It's the same as A-grade office property trading on cap rates of 4.5%. No one's trading or buying office property right now. The cap rates are BS. The high yield spreads are BS. PIMCO came out and said, I don't think I mentioned this in my presentation, it was amazing. PIMCO, which runs private debt, came out and said that 40% of all global private credit borrowers can't repay their loans at current interest rates, and that the extra return you get from private credit is less than half what they would want as a minimum. And that's from PIMCO. So those areas look unattractive. Hybrids. I run the biggest hybrid ETF on the ASX. Now we have the luxury of going up and down the capital stack into senior bonds, tier 2 bonds and hybrids. Right now we've only got about 30% of the book in hybrids, but today hybrid spreads are sitting at 200 over bank bills, 2% over bank bills, paying about 6.5%. Bank bills are 4.5%. The normal spread on a hybrid, a 5-year CBA hybrid, is about 350 over bank bills. So again, they look crazy expensive. The tightest level since 2007. Financials, on the other hand, look attractive. Senior bank bond spreads are trading wide of historic levels. Tier 2 spreads, rating adjusted, look cheap. So I think there are opportunities. Equity valuations, I don't understand. Cyclically adjusted PEs look crazy. The equity risk premium looks crazy right now. You can rationalise it many different ways, but you can get equity-like returns from very liquid, very low-risk fixed income at present, and that's what we do. I'll leave it to the equity guys to justify their valuations.
I just want to pick up on one point Chris mentioned, and there's a question in relation to unlisted valuations, and Chris mentioned office. There's no doubt this is a massive issue for unlisted real estate in the superannuation funds in this country. They are trying to gradually deflate the valuations, but without transactional activity, they can't point to where things are at necessarily. So they're just trying to create a picture of just this gradually deflating situation. But the reality is there's massive redemption queues on a number of Australian unlisted funds, massive redemption queues that are not getting liquidated. The valuations, Dexus is valued an implied cap rate of, say, 7.5%, and as Chris said, maybe 5.5%. So the listed market is saying one thing. The fact that there's not much in the way of transactional activity taking place, and we have this thing called fund choice in this country. This is going to be, I think, something that's a high-risk situation for the unlisted funds.
And what you're seeing playing out, this Armageddon in unlisted commercial property, all the funds are frozen, and it is Armageddon, as Andrew's explaining. Imagine that then propagating into other areas, other funds like private debt, which are also illiquid. And when people have promised monthly liquidity, people want to pull their money out, but you can't get access to that cash. A little anecdote, my mum was advised by, I won't name the group, to invest in the Tribeca Credit Fund. And these dopes were lending to a marijuana business. The whole portfolio blew up, and my mum is sitting there with a $250,000 exposure. I had no idea about this. I didn't endorse it, didn't vet it. I should have. But the advisors on her portfolio report showing her that she's got a $250,000 exposure to a fund that she tried to redeem years ago, and off the record is saying she'll never get anything back. It's ridiculous.
Okay, we're running out of time, so I'm going to quickly get onto your big ideas. Jacob, I'm going to start with you. What is the most exciting idea in your portfolio right now?
Well, we've got many. I'm just going to pick one which is a little bit probably contrarian relative to the view I presented. I presented a view of us being tilted outside the US, being a little bit concerned by the fact that the household was slowing in the US. So we own the largest credit card company in the US, Capital One Financial. Now, the interesting thing about the credit card business is that you provide loans when your growth accelerates. That's when you provide aggressively in the expectation of future losses. So losses are more correlated to the growth in your portfolio rather than the economic cycle. And that's exactly what happened in COVID. So this stock has derated because of the expectation that loss rates would go up, and they have. But the company is well provided for, and its borrowers have obviously suffered from higher rates in that, credit card pricing reprices immediately. When the Fed lifts rates, that immediately hits the borrower. So it's a part of the US economy. That part of the economy will benefit from lower rates. And Capital One recently announced the acquisition of Discover. Discover Card is one of the closed loop networks, so American Express. And those closed loop credit networks typically trade on a very large premium. So you're putting together a scale operator in credit cards in the US with a closed loop network. So there's multiple ways of winning. The current multiple is around 7 times. We think under a Trump administration, the likelihood of that acquisition being blocked actually falls. So there's a way of winning we get from the politics. We don't need that to play out. We can justify the investment without the merging or acquisition going ahead, but then the multiple drops to 5 times. So we're investing in parts of the US where we think there's a recessionary outcome already priced in, as opposed to paying 34 times for Apple.
Okay, over to you, Andrew. Where are you seeing the most opportunity in listed property markets today? And can you take us through a few examples?
So we try and provide something different. Now, I can talk to you about data centres and how great they are, and that's true. But the real, to me, exciting part is 2 areas, healthcare and retail. Now, retail's out of fashion, but as I've showed before, you've got no supply. In the US, you've got multi-decade low vacancy rates because there is no supply, and retailers have realised delivery to the home free of charge doesn't make money. Surprise, surprise. They make their money through the bricks and mortar, so they're all reinvesting in stores. This is the quiet recovery of retail. The other one is healthcare, and I'm talking about seniors housing. You can't fight the demographics. I've tried to counter it. I'm getting older, we're all getting older, the population's getting older. The need for senior housing accommodation, particularly given age and the US population health deterioration, the demand for this type of accommodation is growing. There is no new supply taking place. This is just a great cash flow growing story.
Can you get a little more granular than that? What are some of those actual names?
Well, they're in the RCAP portfolio, which is listed on the exchange. There's 45 names. Singling out individual names, I've learned over the years, you look back, quite often it's not that one that does best. I'm not going to single out names. We've got 45 great securities in retail, in residential, in healthcare, in data centres, in self-storage. That's my pick for today.
Okay, over to you, Chris. What's your most exciting idea right now?
So you need to understand that uncertainty or volatility, it expands with the square root of time. We all know where we're going to be in the next 10 seconds, but I don't know where anyone's going to be in the next 10 hours. So our trading is very focused on the new issue markets, the primary markets, and that's the most exciting opportunity. So unlike the equity market, equities can see the IPO market shut down for 6 or 12 months, and there can be a lot of illiquidity in the equity market. But in the bond market, when companies have debts that are maturing, if CBA doesn't repay that debt, it's trading insolvent, so they have to issue. So we're literally getting globally hundreds of new bond issues each week. We've traded about 200, as in bought and sold 200 new bond issues in the last 6 months, more than 1 a day. We make money 80 to 90% of the time, and we're pulling out small interest rate mispricings, typically about 15 basis points. But as I mentioned earlier in my presentation, with a typical capital gain of 0.4 to 0.6% every 3 days, that generates IRRs of around 36% per annum. Now, we can't be 100% invested in new issues. I wish we could, so we have to have some secondary trading, and that dilutes the returns down. But the new issue market, as the bond market gets bigger and bigger, governments issue more and more debt. Today, the Aussie government's issuing a new bond. We bid for $1 billion of it, right? It's only mispriced by about 1 basis point because it's a sovereign bond. It's the market's more efficient. But that primary alpha engine is massive, it's relentless, and it's why we have people in Sydney, Melbourne, Auckland, London, and soon to be Miami. Everyone's welcome to come and see the Miami office, to be able to trade those global markets 24/7. And it's a very consistent source of alpha. We only need to get interest rates right today on a single bond. We're not trying to forecast macro or guess where the RBA will be in 12 months.
Okay, over to you, Anthony, really quickly, because we are running out of time.
Yeah.
What's your highest conviction idea?
So from a valuation perspective, the very best opportunities are screening in global mid and small caps today. So not those mega caps where valuations are particularly rich. And one company that we particularly like is probably the most important company that you've never heard of. And that's a company named BE Semiconductor, listed in the Netherlands. It is a company that specializes in producing the machinery that allows hybrid bonding, which is stacking chips on top of one another. So essentially it's allowing stronger compute and processing power in terms of the hardware for devices, has better margins than TSMC and ASML. It has 90% market share of that market, and we expect that stock to double.
Okay. Do you think the US has the ability to pay the interest of its debt at the current level?
Look, it can, obviously, because it's the world's, let's call it, reserve currency, and so it has the special privilege of being able to issue debt to foreigners in its own currency, and so yeah, look, it's worked for a long time. But you are reaching that point where the Treasury, because it's funding at the short end, and that's the big risk, for the bond market in the US, is it's really rolling, it's record issuance of notes versus bonds. So as it starts to term out that debt, it really will put a lot of pressure on the long end, the 10-year bond. So you may have an environment where the Fed cuts, but quite frankly, they have to, because they've got to get term premium back into the Treasury market. So investors actually pony up to buy those long-dated bonds. So you are reaching arguably constraints, and it will be an issue for the dollar in the longer term if the US doesn't find a way back to a balanced budget. And because of populism, the chances of that happening, I think, are falling, because you've got populism on the left, populism on the right, and both want to spend money, just on different things.
I'd just add that, I think this is the issue of our time, where the political reflex, you see it with Dan Andrews in Victoria, just spend as much money as possible, effectively financially conflict all the voters, put 1 in 2 Victorians directly or indirectly on the public purse. Victoria owed 40 to 50 billion prior pandemic to the world. It now owes almost 300 billion to the world. And every politician globally is sort of displaying similar propensity. So the question is, who's going to buy all the debt? I don't think it's a question of whether they can service the debt. The issue is who's going to buy it all and at what interest rate. And I think the challenge for financial markets is the interest rates that bond bandits like ourselves will demand could be significantly higher. And again, that perturbation in the UK with the mini budget crisis. Elizabeth Truss rocks up and says, I'm going to spend 42 billion sterling of extra money. I don't know where I'm going to get the funding for. And the UK government bond market turns around and says, well, we're going to charge you 200 to 300 basis points more in interest, and almost bankrupted the UK pension system. So I think over the next 5 to 10 years, this is something that investors really need to focus on, is the risk of higher long-term discount rates, potential sovereign debt crises around the cost of capital, and that steady state cost of capital that bond markets are going to go impose.
And I just add, you don't have that issue in most of the major emerging market economies. They have adopted policies of fiscal responsibility, ironically.
Okay, well, I hope everyone enjoyed that as much as I did. I hope we can all give a round of applause to our panellists today.